All right, let's get into it. Today, we're diving into a fascinating story where a true catastrophe created, believe it or not, one of the most unusual investment opportunities I've seen in a long, long time. We're talking about Hawaiian Electric and how the market's pure, unadulterated fear opened the door for a pretty clever bet on its recovery. A bet that cost absolutely nothing to make.
It all started right here, with this one, brutal number. In the wake of the devastating Maui wildfires, Hawaiian Electric stock didn't just dip, it completely fell off a cliff, a 72% collapse. You have to understand, the market was in an absolute panic, basically writing the company off for dead.
And this quote from our source material really gets to the heart of the whole thing. The market had what's called a profound distress skew. Okay, so what does that mean in plain English? It means the collective trauma from the disaster made investors so terrified of another crash that they were willing to pay a fortune for what was essentially disaster insurance on the stock. This powerful emotional bias, well, that's the key that unlocks this entire strategy.
So, here's our game plan for breaking this all down. First, we'll set the scene and look at the company in crisis. Then we're going to explore this wild zero-cost bet that popped up because of all that fear. We'll dissect the anatomy of the trade itself, piece by piece. After that, we'll uncover the hidden safety nets that most people missed. Then we'll chart the company's path to recovery, and finally, we'll see how this whole thing was really just a bet on reality itself. Okay, first up, a company in crisis. To really get why this opportunity existed, you first have to appreciate the sheer scale of the disaster Hawaiian Electric was facing, and why the market reacted with such extreme, gut-wrenching fear.
The timeline here was just brutal and incredibly fast. August 2023, the wildfires hit. A year later, the company itself, with all these liabilities piling up, had to warn investors about a going concern risk. Now that's just corporate speak for, hey, we might not actually survive this. As you can imagine, the market totally freaked out, the stock went into an absolute free fall, and suddenly bankruptcy looked like a very, very real possibility.
And that brings us to the zero-cost contrarian bet. See, this is where the story pivots and gets really, really interesting. We're going to see how this moment of just peak fear created this unique window for someone to make a powerful bet on recovery without putting up a single penny.
So, let me just ask you this. What if you could take all that panic, all that fear sloshing around in the market, and actually harness its energy, use it to fuel a bet that the company would get back on its feet, and do it for free? I know, it sounds kind of impossible, right? But that is the absolute core of this entire strategy.
The tool that makes this all possible is something called a risk reversal. Now, it sounds complicated, but the idea is actually pretty simple. You want to bet on the stock going up, right? So you buy a call option. But to pay for it, you sell a put option, which is basically a bet someone else makes with you that the stock will go down. Now, in a normal, calm market, this wouldn't work. But here, the fear was so intense, the money you got from selling that downside insurance completely covered the cost of your upside bet.
So let's talk about the anatomy of the trade. How is this thing actually built? Because when you break it down, it's like a really elegant piece of financial jiu-jitsu, using the market's own weight against itself.
Just think about it in these 4 steps. It's beautiful. Step 1, you sell disaster insurance to all the panicked investors out there. That's your put option. Step 2, because they're so scared, they pay you a huge chunk of cash, a premium for that protection. Step 3, you immediately take that cash, turn around, and use it to buy yourself a recovery ticket. That's your call option, the thing that pays off if the stock bounces back. And the result? Step 4, you're left holding a zero-cost bet on the company's comeback, paid for entirely by the market's own fear.
So what does this actually look like when the dust settles? Well, there are 3 possible outcomes. If the stock completely tanks and falls below $10 a share, you lose. You're on the hook to buy shares at $10. But if the stock recovers and goes anywhere above $15, your upside is basically unlimited. Now here is the really cool part. If the stock just kind of muddles along and lands anywhere in that zone between $10 and $15, nothing happens. Both bets expire worthless and you walk away breaking even. No gain, but no loss. That buffer zone is a massive advantage you just don't get by buying the stock outright.
Okay, so this all sounds great, but you're probably thinking, wasn't this just a ridiculously risky gamble? And that's why we have to talk about decoding the hidden safety. Because while the market was staring at all the risk, if you looked a little closer, there were these powerful safety nets that made a total wipeout much, much less likely.
The first, and honestly the biggest safety net, was this number right here, $1.99 billion. A global settlement capped Hawaiian Electric's total liability from the wildfires at that fixed amount. This was an absolute game-changer. It took a terrifying, unknown, potentially infinite risk and turned it into a known, manageable number. For the first time, the company knew exactly how big the bill was.
Safety net number 2 was the company's tangible book value, which was sitting right around $10 a share. You could think of this as the fire sale price, what all the physical stuff, the power plants, the power lines, all of it, what it would be worth if you sold it for parts. This creates a pretty solid floor for the stock price, and notice it's conveniently right where the risk in our trade begins. For the stock to fall much below this, you'd have to believe all that equipment was basically worthless.
And that brings us to the final brilliant backstop, the state of Hawaii itself. They stepped in with something called Act 301, a legislative package that provided over $800 million in support. And this sent a crystal clear signal. Look, Hawaiian Electric provides power to 95% of the state's population. It is quite literally too essential to fail. The government was never going to just let it go under.
So now we get to the path to recovery. Because these safety nets, they didn't just prevent a total collapse. They actually laid the groundwork for the company to stop the bleeding, stabilize, and start to rebuild.
And this recovery wasn't just some theory. You could see it happening in real time. Check this out. They secured the cash they needed, raising over $1 billion. They got back to being profitable, reporting actual net income. The big credit rating agencies like S&P saw this stability and started upgrading their outlook. And maybe most important of all, the capital markets reopened to them. They proved they could borrow money again, which is the ultimate sign that the financial world believes you're going to make it.
And this wasn't just about survival, it was about rebuilding for the future. The company laid out this big plan to pour hundreds of millions of dollars every year into strengthening the grid. Now, for a regulated utility, this is everything. Every dollar they invest in the system gets added to their rate base, and that's the asset value regulators let them earn a profit on. It's simple. More investment literally means more future earnings. This is the engine that was going to drive the stock price higher.
Okay, so let's put all these pieces together. This is what it all boils down to, a bet on reality. When you zoom out, you see this fundamental conflict playing out in the market, a battle between two completely different stories.
On one side, you've got the bear case. It's driven entirely by memory. The trauma of the disaster is just so powerful that it's keeping the stock price pinned down, anchored to its past. But on the other side, you have the bull case, and it's driven by simple math. The math of the settlement cap, the tangible assets, the new investments, the guaranteed earnings growth, all of it points to a fair value way up above $15, closer to $17 a share. This entire strategy was just a bet that eventually math was going to win out over memory.
And that really leaves us with one final big question to chew on. In these moments of extreme crisis, when emotions are running hot and everyone is panicking, what really drives the market in the long run? Is it the powerful emotional memory of what just happened, or is it the cold, hard math of what a business is actually worth? The answer to that, well, that's what this entire trade was betting on.